Hello, in this presentation we will record an adjusting journal entry for an invoice that was created in March but for which the work was done in February. So we have to bring back that work or bring back that information from the invoice to February. If you've been following along with us, we will be continuing with the Get Great Guitars problem. If not, that is okay. We're going to be doing an adjusting journal entry for an invoice that was created in the following month for which we are doing the financial statements, and therefore, according to the revenue recognition and matching principle, we need to bring back the revenue for that invoice in the time period that it was earned, as well as any related expense, including cost of goods sold. That's what we'll do at this time. This is a good practice as well, just to get an idea of what is being recorded in terms of the journal entry when we create an invoice. If you have the backup up to this time, you can restore the backup, go into File and Restore. If not, that's okay. We can follow along. We can work through the problem to get to this point in time. We currently have the current windows open. In order to open the current windows, you go to the View tab and open Window List. We also have the Home tab open here, so that can be found at the Company and Home tab. What we will do is we're going to go to the balance sheet first, take a look at our objective, and then we'll go back and look at the invoice that we will be adjusting. So we're going to go to the reports up top, we're going to go to company and financial, and then down to the balance sheet standard. We're going to change the dates to the dates we are working out in customize reports. We're going to create a range so that when we drill down on the information, we can see the range 01/01/21, January 1st, 2021 to 02/28/21, February 28th, 2021. We're going to say OK. This is our information. What we have here, and let's open one other report, and that's going to be the profit and loss. Reports, we're going to go to the company and financial and profit and loss and select the date range once again of 01/01/21, January 1st, 2021 to 02/28/21, and this is going to be the information that we're going to be working on. So our cutoff date, in essence, is February 28th. What we're saying here is there's an invoice that should be recorded here. This is our income account. If we double click on the income account and we go through these invoices, we're saying that there's an invoice here that should be here, which is not, which was entered as of the following month. And we need to pull it back in accordance with the revenue recognition principle. Now, this could happen for a couple different reasons. One, oftentimes it happens with a service company because when in the normal process of us creating an invoice, we will have to track everybody's time. And if we were doing guitar lessons, for example, we'd have to track everyone's time, create the bill, then send out the bill. So it's very possible that the work was done, the lessons were done in, say, in this case, February, but the invoice didn't go out until March, and therefore the revenue didn't get recorded to March. In terms of a perfect accrual system, even though this little icon says accrual, what that really means is QuickBooks is being driven by when the invoice is created. And so the invoice creation is when QuickBooks records revenue rather than when cash is received when we have this little accrual icon selected. If, however, the invoice was made after the time when revenue was recognized, it's still not in accordance with revenue recognition principles, and we should bring that back if we were to formally create the financial statements and really know how we're doing in a current month in terms of how much we earned. And if we wanted to make these reports for outside users, we should have that revenue included in the report at the time that we did the work. So we need to pull that back to this point. Now, I haven't created the invoice at this time because I'm actually going to create the invoice and then show you this report again and see what it would look like and how we would detect that, or one way we can detect that, and then we'll go back to here. Now, we're not going to do this with the service item. We're going to do this with an inventory item rather than the service revenue for an invoice, because we want to see the whole journal entry, the most complex journal entry, one that deals with not only just revenue, but with cost of goods sold. So this is a situation where we sold a guitar. The guitar invoice was entered in March, but we actually shipped the guitar in February, And therefore, when we look at the shipping documents, according to those, we should have the inventory or the sale recorded in February. So we need to pull that back. So what I'm going to do is I'm going to show what the invoice looks like first by creating the invoice in March. And then we'll take a look at it, and then we'll discuss on how we can pull that revenue back into the current time period that it was actually earned. So we're going to create an invoice for March. So I'm going to select Create Invoice. And we're going to say the customer is going to be, let's see, Sam the Guitar Man. And we could just type that in there. And we're going to say then the date is going to be 03/02/21. So March 2nd, 2021, after our cutoff date, is when this invoice was entered. We're going to show that what's going to happen when we enter this so that we can then recreate it with an adjusting journal entry. It's journal entry number 19. All this information will be the same. We're going to change the terms to net 30. The item that we will have is going to be that ELP guitar. QuickBooks automatically assigns tax. That's good. We're going to have quantity will be one of those. So here will be our invoice. We do want sales tax. So I'm going to go down to the bottom and we're going to say that tax will be applied. Okay. And so there's our 500. There's the 25 sales tax. Here's our transaction. It's going to be recorded in March. Now, we're going to say that this was recorded even though the sale happened prior to this date, even though the sale happened in February. So for whatever reason, we didn't enter the invoice until after the guitar was actually shipped, until after we earned the revenue. We're going to record this and see what it looks like in March, and then we're going to talk about how to pull that information back. So if we record this, it's going to do a few things. It's going to increase revenue by the 5,000. It's going to increase the accounts receivable by 525. It's going to increase the payable in terms of sales tax payable by 25. And then it's going to decrease inventory by an amount we don't see here, but we will see it when we analyze this process. And then it's going to record a cost of goods sold. We need to know all that in order to make this adjusting entry and understand what is going on. So we're going to say save and close and then go observe that. So we'll say save and close. And yes. And then we'll go back to our reports. We're going to go to our reports, and now we're going to look for the next time period. So I'm going to look for the month after what we are working with, which is going to be 03/01/21, 03/31/21, and here's that information. We're going to do that same thing for the balance sheet, and we can see it here. We'll go to the customize reports and change the range again to 03/01/21, 03/31/21, and OK. So here is going to be our reports as of next month, the following month of our cutoff that we're making the financial statements for. If we go back to the profit and loss, we see that we have that revenue of the 500 here. There it is there. If we double click on it, here it is here. If we close that back out, we have the cost of goods sold. We don't see that on the invoice, but it has been created from the invoice. If we double click on that, we see the item. If we double click, there's the invoice. So the cost of goods sold is 400. Closing this back out, closing this, going to the balance sheet, we're going to see that we have the receivable. Double clicking on the receivable, double clicking on that. There's the receivable for the 525. If we close that out and close this out, we also see that we have the payable in terms of the sales tax payable here of 125. Double click on that, double click on that, there is that. So we're going to close this out and close this out. We're going to go back to the profit and loss because it's easier to see here it being our only transaction in the profit and loss for the next month. And this is how we would really pick this up. We would go through the merchandise sales and try to see the recent sales in the following month and say, did we really earn the revenue in that time period, or was the revenue earned prior to that? How can we know? If it was merchandise, we can check the shipping documents. If it was something like time that we did service, like guitar lessons, then we can see the dates. We can go back to the data and see when the actual work was done. That's when we should be recording the revenue. So for whatever reason, we recorded this invoice in after the guitar was shipped, and therefore we have this problem where the 500 is recorded in the month of March. We need to pull it back to the month of February. Within QuickBooks, it is possible for us to just double click on this, and change the date. And we typically, however, we often don't want to do that because there might be a legitimate reasons for having the date within QuickBooks. And if it was a normal service business, that might just be our normal process that we bill every couple weeks, and we want to keep that process in our normal process and then just do an adjusting entry. It also could be that this invoice was already applied out. We might have already paid it. It might be tied to a purchase order. So it might be something typically within accounting systems, we don't go back and change the dates. Many accounting systems will not let us do that. It's better to have an audit trail oftentimes. So for that reason, we're not going to go back and do that adjustment. What we're going to do is just a journal entry to make our financial statements correct as of the cutoff date, as of February 28th, with just a journal entry, and not mess with the actual invoice. So we're going to pull this information back to February. There are a few different ways we can do this. The traditional way would be that we would go to company up top and we would make a journal entry and just make a journal entry and reverse everything that happened in terms of debits and credits. But if we don't know the debits and credits, we could do this without the debits and credits. So we're going to do this with registers and try and put this in place with registers. So first we're going to think about the sales half of this journal entry. So when we think about the sales half, we have this 5,000 here in revenue. The other side of that went to accounts receivable. And so the accounts receivable is up top here. So we had the 525 in accounts receivable and then the 25 that is in the sales tax payable. So that's what we're going to deal with first. So what we're going to do is just pick a register that is in one of those areas. We can't pick the income statement register of revenue, and therefore we'll have to pick either accounts receivable or sales tax payable. The accounts receivable register is a little bit different in its format, and therefore we're going to put this in place actually by looking at the sales tax payable register. So we're going to go to the sales tax payable register and try to see if we can put this information into that register without using debits and credits. So we're going to go to the banking up top. We're going to go to use register. And instead of the checking account, we're going to scroll down to the sales tax payable, which is going to be a liability. So we have sales tax payable and OK. Here is our sales tax. Now this one went up by the $25, and we can actually see the transaction up here. So what we're going to do is we're going to bring that back into February. So we're going to say this is as of 02/28/21. We're going to record it again, but as of our cutoff date. And we're going to tab through this. I'm going to see if we can we will need a vendor. So we'll say it's the same vendor, New York State. Type that, New York State. And then it's going to be the amount billed will be 25. And then what we would like to do is put the other accounts, but there's going to be two of them that will be affected here. So we're going to say split this account, and there should be two other accounts affected. Now it's going to be a little bit tricky to think about. The other two accounts that will be there's the 25, and then we made a sale, a merchandise sale. So that's going to be the revenue or income account. And remember that if we looked at the invoice, the income account was for 500. So we're going to say that there's 500 there. The merchandise sale is going to be 500. We're going to have to put it in as a negative 500, and I'll try to explain that in a bit. And then the other account that's going to be affected is going to be the accounts receivable. The accounts receivable. And that will be for the full amount of 500 sales plus the 25 or 525. Whenever we have a receivable, we will need a customer. So we have to put the customer in there because QuickBooks will not let us record it unless we have the customer. And I believe we created the customer here for Sam, the guitar man. Alright, so that's going to be our entry. Now this is a little bit confusing because we're trying to avoid debits and credits, and we still have problems in this format even though we're trying to avoid them by having pluses and minuses. So if we read this, we're saying we're trying to increase the payable of 25. we know there's two other accounts affected, which would be the sales and the receivable. Typically, when we work it in this format with registers, there's only one other account affected. So if this account was going up by 25, then the other would do whatever it needs to do. QuickBooks would just say, okay, I'm going to do whatever else I need to do to the other side, debit or credit it in accordance with whatever is needed. In this case, we have two other accounts, and therefore we have to do some figuring on, which is increasing or decreasing without using debits and credits. So we could use some trial and error. We know the other two accounts are going to be the merchandise sales. We sold it for $500, and the receivable, they owe us the sales price plus the $525. If we put it in there incorrectly and we try to record it, QuickBooks will say you're out of balance, and then we can switch these two, and then we can figure out what is the correct amount. If you wanted to do this with a journal entry, the more typical kind of way to do this with debits and credits we would say that we're going to debit the accounts receivable by the $525. We would need the customer field. Then we would credit the merchandise sales for the $500, and that would be the sales price. And then we'd have the payable that we would have to credit for the added 25 here. So let's go ahead and record this, and we'll see what happens. So we're going to go to the balance sheet. And if we go to the accounts receivable up top, I'm going to change the date to the 01/01/21. And if we scroll down here, we now have entered it there. So we've kind of duplicated this amount. There it is on the month after. Here it is at the cutoff date that we want it at. So that looks correct. We're going to close that. We're just duplicating this transaction. If we go to the sales tax payable, we see right here, we double click on that, and we change the date and the beginning date to 01/01/21, and scroll through here. We should see that again. We just basically duplicated this amount with that transaction. That's what we want because we want to pull it back into this month. So we've recorded it 2 times in essence, closing this back out. If we go to the profit and loss, we go to merchandise sales, same item, change the beginning date, 01/01/21. We see the double of that 500, so we pulled it back into 228. So that side looks correct. Now we're going to record the other side of it, which is the cost of goods sold side. So that's cost of goods sold, and the other side is the balance sheet of inventory. So if we scroll up to inventory and double click on inventory, and we change, we got that 400. So double clicking on that, there's being created by this here. So we're going to duplicate that as well, and we're going to do that with our registers. So we're going to try to go into the inventory asset register and do the same process to pull the inventory account created by this transaction back into the prior month. So we will go to banking, we're going to go to use registers, and we will go to the inventory asset register and OK. The date, and we're going to pull it back to 02/28/21, our cutoff date. And we're going to just try to duplicate this 400. So it's going to be 400, and it's going to go to the accounts receivable account. It's not going to go to the accounts receivable account for us. It's going to go to the cost of goods sold account. The other side is going to be cost of goods sold. The reason it's got accounts receivable up here is because it's showing the split. So if you were able to see all the accounts, we'd have to double click on it, and there's the invoice, and then we can interpret what is happening. So it's trying to tell us there's a bunch of other accounts involved. We did ours in 2 journal entries, 2 transactions, and therefore we're just going to, this one will be easier than the last one in that there's only one other account. The inventory is decreasing by the 400, and the other side then is going to the cost of goods sold, that expense related to the inventory being used in order to help generate revenue. We're going to go ahead and record this, and then if we go back to the balance sheet and we go to our inventory, we're going to double click on it, and we're going to change that beginning range again to 01/01/21. Scroll through there, and there we've duplicated it at the 228. So there it is there. We pulled it back to the account we needed in, the time frame we needed in. Closing this, go into the profit and loss. If we double click on the cost of goods sold, change that beginning range 01/01/21. there again we see that we pulled it back here to that 400. So that's what we're looking to do. I'm going to close this back out, and so what we have done now is pulled that information back to the date we wanted in. If we want to look at that in summary, we're going from 01/01/21 to 02/28/21, and we're saying that we now have in the income statement that the time frame that it should be in, this invoice has been recorded and pulled back into that date, recording the appropriate amount of revenue and expenses. If we go to the merchandise sales, we see that amount of revenue here related to this transaction. If we go to the cost of goods sold, we see the 400 cost of goods sold. And if we go to the balance sheet and change that date range again from 01/01/21 to 12 or to 02/28/21, we then see the accounts receivable here scrolling down of the 525, and we should see the payable in terms of the sales tax payable, double clicking on that, of the 25. So there's that information. Now this was a longer process, of course, because this was a process with recording the invoice, and we did so not by creating another invoice, but by doing something similar to creating journal entries working with the registers. Now you'll note that we have created our financials to be correct as of the cutoff date, as of the date of the financial statements, which is February 28, 2021, but we have in essence duplicated this transaction. We've duplicated that sale. We've duplicated the accounts that are affected from that invoice that was created in March. So what we need to do now is go back and do a reversing entry. So next time we'll do a reversing entry, and we will reverse this transaction as of the first day of the next month, so that we don't duplicate it as of the time the invoice was actually generated in the next month.